Hello, in this lecture we're going to define profit margin. According to Fundamental Accounting Principles, WILD 22nd edition, the definition of profit margin is ratio of a company's net income to its net sales, the percent of income in each dollar of revenue, also called net profit margin. Let's take a look at an example. If we were to think of revenue as being 100,000, we are generating revenue over a time frame of the 100,000. And total expenses being 80,000, then we would calculate the net income of revenue minus expenses at 20,000 in this case. The profit margin then would be the comparison of the net income to the revenue. In other words, the profit margin equals net income divided by the total revenue, and that in this case would give us 20%, 0.2, or 20%. One way to think of this is to think that as every dollar sale that we have, we're walking away with basically 20 cents for each dollar sales. We often represent that by putting the profit margin percentage, the 20%, next to the net income number. And if we were to think about the rest of this equation, we could think about revenue related to revenue, which would be 100,000 divided by 100,000, which is of course 100%. If we were to relate the expenses to the revenue, we would be relating 80,000 divided by 100,000. That would give us the 80%, and that can give us some context that we're basically saying revenue is 100%, 80% is being consumed in order to help us generate that revenue, leaving us with the 20% profit margin.